Hey everyone, welcome to High School Dropout's advice. If you need subtitles, please click on the subtitle button right here. The subtitles are still there, but sometimes need 1-2 hours to display. A very quick Ehang update again, and I noticed that there were viewers with concerns about investing in Ehang. So let's get started. Quick recap. We had awesome news that the government was investing over 306 million into Ehang without the need to get equity from Ehang. So we can see it as a gift. If you want to watch the whole video, I will link it up here and down in the description. So we have the concern of Chris. Why haven't Ehang announced any of this news yet? They did on Twitter, as you can see here. But they have to wait for the government. Details are subject to being released by the government. So we have to wait for the government to release the details. You might know that Ehang had a couple of trial flights in Korea in November 2020. According to the Korea Herald, South Korean investors holding 550.3 million worth of shares in Chinese drone maker Ehang Holdings. However, the stock has plummeted since the Wolfpack accusation. It was the 7th most active US listed stock this year, as Korean individuals and corporates investors traded 804.3 million. Based on the history, the more recent news that South Korea has ordered 50 EH-216 seems believable. We should have news in the earnings release very soon, as you can see here. We all can agree, since the trade war and the recent meeting in Alaska between the Chinese and the Americans are building more tension between the two, which also reflects on the Chinese stocks. So let us have a quick look at the most updated source of the well-known Buffett indicator. We see, according to the Buffett indicator, the Chinese stock market is fair valued. The ratio of the total market cap in China of the stocks over the GDP was in the recent 10 years at the maximum of 92.15% and a 10-year minimum of 38.69%, with the current rate being at 64.26%. Based on the newly introduced total market cap over GDP plus total assets of central bank ratio, the stock market is modestly overvalued. So overall, we can say that the Chinese stock market is healthy. The projected annualized return is at around 5.8% for China. Egypt is outgrowing everyone, interestingly. I will look into this. This really surprised me. Let me show you the total market cap of the stocks trading around the world. We see that the US is leading with nearly 40 trillion. This is almost 4 times as much as China. We have Japan ranked 3rd, followed by Hong Kong, UK, France, Saudi Arabia, Germany, Canada, and India. If we compare the stock exchanges, we can see it again. The New York Stock Exchange has a market cap of 29 trillion and the Nasdaq has 10 trillion. The Shanghai, Shenzhen and Hong Kong stock exchanges are around 3 to 5 trillion each. This shows how much money is in the US stock market. But why is this so? According to Investopedia, 52% of US households own stocks, and equities are a large part of households' wealth in the US. Chinese, on the other hand, like to invest in properties, wealth management products, and bank deposits. Only 7% of Chinese own stocks. This is maybe why the valuation of all Chinese companies is lower than the counterparts in the US. Chinese companies are not used to raising cash with stocks. They usually are going to the banks. US companies are often raising cash by offering stocks. So both countries creating a different dynamic. But there is a new trend coming. Millions of new investors piled into mainland Chinese stock market in 2020. The same situation happened in the US during the lockdown. Many people start to learn to invest. The same happened in China and is still a lasting trend in both countries. I think this is in general a very good sign. Investment can create wealth, but having so many new retail investors, we will see non-traditional moves. We already see how volatile stocks are nowadays, and some companies having undeserved high evaluations. So investing in this era doesn't mean more risk, but it will certainly be more volatile. Important is to do your homework, pick the right stocks and just hold them. With the help of social media, this era will create a lot of noise, creating more volatility for an already volatile crowd of investors. I know that some investors also have concerns that Chinese stocks get delisted from the US. But let me show you a couple of things and why I don't think it will happen. China is the 5th largest foreign holder of US securities with 1.5 trillion. China also has 238 companies listed in the American Stock Exchange. China is the 2nd largest holder of treasury debts of the United States. You might have watched my video explaining the relationship between bonds, yield and the stock market. If you didn't watch it yet, I will link it up here and in the description below. China is buying bonds, which help to keep a low yield is better for the stock market because money becomes cheaper. When money is cheaper, it's easier for companies to take a loan, develop, research and grow. If the US delists Chinese companies, China could stop buying the bonds, which will force the yield to go up and slowing down the US economy. You saw in the last 3 to 4 weeks that the yield is spiking and the stocks are tanking. So I don't think that it's in any country's interest not to trade with each other. Both will gain more by cooperating, but this is only my humble opinion. At this point, I have to say for legal reasons that I'm not a financial advisor, I'm just a guy on YouTube. Do your own due diligence and remember, your money is your responsibility. And please subscribe to my channel if you enjoyed watching it. Please also share it with your loved ones and check out my other videos on my channel. Many thanks and see you hopefully in the next video. Thank you, bye!